So easy, so easy. So easy, so easy.
Hi everybody, and welcome to our webinar today, where we're going to be talking about the Satrix MSCI China ETF. If you've just joined us, yes, we're chatting China ETF today. I'm really excited to be joined again by some familiar faces for a lot of you. Our ETF expert from Satrix, Kinglsey Williams, who's the Chief Investment Officer. He's also got loads of experience in research and portfolio management. So he's joining us again today to bring all the smarts. And then one of our own community, Tisa. She's actually joining us from China herself. So it's going to be very interesting hearing her thoughts on this ETF. You may have seen her in her YouTube channel as well, Financial Chats with Tisa. So go and check her out if you haven't, but we'll get to chat a bit today as well. Tisa, how are you doing?
Hey, Carly. I'm very excited to be here with you again today. And what a perfect ETF to talk about, the MSCI China ETF. When I first got introduced to this ETF, it was through an email that I got from EasyEquities about launching an IPO. That was last year, right? That's when it was launched. And I immediately thought, I am definitely investing in it. I can't put it in my TFSA because I had already exceeded the 36,000 limit that you can invest in your TFSA per tax year. So I thought, let me just buy it in my EasyEquities ZAR account. And then in the new tax year, I'm going to add it to my TFSA. And I did just that. So I'm really excited to be talking to you and Kingley today about this ETF.
Nice. Well, welcome. And thanks for joining us from China. And you can also just say hi, Kinglsey. I'm not done with Tisa, but just you can say hi to everyone. You've got fans.
Hi, Carly.
I can't see.
Hi, Carly. Hi, Tisa. Good to see you both again. And Tisa, it looks like the sun is setting wherever you are, or maybe you've just got fantastic lighting. I'm not sure which one it is.
It's definitely set already. There's 6 hours between China and South Africa.
It's all an illusion. So how long have you been in China, Tisa?
It's actually been 2 years and 4 months that I've been in China. And I have to say, when I first got here, things were a bit different and overwhelming because it's such a different world to South Africa. Everything was a little too advanced for me in the beginning. So I had to ask for help everywhere I went. And I don't even know how to speak Chinese. So asking for help was a bit difficult. But then later on, when I became acquainted with my environment, the culture, the people, and just how things work, I was like, okay, I'm here to stay.
So have you learned any Chinese now? Can you speak any Chinese?
Of course, 我可以说中文一点点.
Oh my goodness.
I said I know how to speak a little Chinese in Chinese.
How would you say hello and welcome to this webinar?
I can say hello, ni hao. That's very easy. Ni hao. Yeah.
Okay. I should have started with that. It would have been so impressive.
Great.
So one of the things that I was looking at, like you said, when this ETF launched, I think it was about a year ago, I realized that there are a lot of ETFs that have, well, not a lot, but there's some ETFs that do have some exposure to China in them. But there's actually not a huge amount of exposure to China in these ETFs, which is what I thought was quite interesting. And I sort of felt, looking at my TFSA portfolio as well, I realized I've got a lot of kind of, I guess, American stocks. And I realized that I might actually be under, I guess, exposed to the Chinese market. So I did the exact same thing as you. As soon as I got my TFSA allowance open up again this financial year, I made sure that I added some MSCI China to the mix. So yeah, I don't know what you think about that in terms of the mix that's in your TFSA and how this fits in there.
I feel the same way that you feel about it. And I'll add that because we already are exposed to a lot of the big tech companies in the US, we use their products, we use their software. It's easy for us to relate and be like, yeah, I know Apple, I know Microsoft, I know all these companies. Yeah, I'm definitely going to invest in it. But then with China, it's like, well, what is Tencent? What is Meituan? What is JD? What is that? Is it some small tech company? Is it, we don't know how big it is because we're not necessarily using those particular products or that software or whatever it might be. So now that I'm in China, that's why I got so excited when the IPO was launched. I was like, I definitely want to invest in China now that I have the exposure and like seeing how big it is. I mean, the difference also with China is that they have a huge population. This country is very huge. It's like one province in China feels like the whole of South Africa. I'm not even exaggerating.
Wow.
So they have the population that is using their products, the software and all of that. So even if we're not necessarily using it in other countries, they're still making a lot of money, like a lot. So it's quite big.
Yeah, I always forget about that aspect with countries that kind of fall under the emerging markets umbrella, is that their populations are always something that you need to think about. If anyone wants to kind of read a bit more into emerging markets, there is another webinar on the EasyEquities YouTube channel where we kind of really went in depth on that. And that was my biggest takeout, was like, you don't even think about just purely the number of people with access to these companies and services and how that actually impacts the performance and the sentiments around them. So I see you've got your notepad there.
Of course, every time.
I'm sure that you're going to want to pick Kinglsey's brain as much as
yes.
I do, but I'm getting in there. I'm getting in there first. Kinglsey, I just wanted to ask you, kind of touching on what we spoke about. I think, for me, when I look at global ETFs as a general theme, I've always seen it as a really good way to diversify my risk in my portfolio. So I am invested locally. I'm invested in ETFs like the Satrix Top 40, and I do have a portion of my portfolio in that. But when there is some country-specific instability, I always just find a lot of comfort in also being invested offshore to kind of mitigate that risk. So I guess thinking about that context, as well as other context, why is China a good sort of area to look at when it comes to offshore investing? What is it about China that you think could be appealing to investors?
Yeah, great question, Carly. The really interesting part about China, and Tisa touched on it, is just the enormous population that exists there. I was just having a look now. It's close on 1.4 billion people. Wow. I mean, the mind just boggles at how large a population that is. And the companies that are serving those, the people living in China predominantly, just have massive economies of scale to be able to build businesses. So a lot of the businesses might seem unfamiliar, as Tisa was mentioning. They're not necessarily household names that we're more familiar with, particularly those global tech companies, which we covered in the NASDAQ webinar recently. So, if you haven't watched that, have a look at that as well. So these companies might not be as familiar, but the reality is the number of customers they have, and I'll get into that later, is just staggering. How many customers they serve on an annual basis. It's multiples of the population of South Africa, 10 to 12 times more the population of South Africa. That's their customer base. So, even though these companies may not necessarily be global, that's also the opportunity that exists down the line, is that as these companies look for growth elsewhere in the world, they could then start expanding, as the US companies have, which are now household names for us all over the world. They provide services to people living in all different countries around the world. These Chinese companies could also grow and expand their their client base outside of China, because they've already got such a massive economy of scale, that they've been able to achieve within the Chinese market. But one of the key attractions of the Chinese investment case is their gross domestic product, and really that just means how fast the economy is growing, and that's been part of a mega trend that's been unfolding for the last few decades as the economy is modernized, as they put a lot of investment into infrastructure, and really grasp the bull by the horns to invest in technology and use technology in innovative ways to be able to leapfrog in many senses the much slower growth, we've seen rapid growth in technology globally, but that's evolved over a long period of time, and China's really been able to leapfrog a lot of those technologies and be able to deploy them very quickly. And we've seen the size of the cities in China, and I've got a slide to cover that as well, just how staggeringly large those cities are, and all of the services that are then needed to service everyone living in that fairly confined space. You need to employ technology to be able to do that. So a lot of innovation coming out of China, high growth rates, and that's obviously reflecting in them becoming a bigger and bigger portion of the global economy. And I'll share a few slides on that in a moment as well.
Okay, yeah, that's really interesting. Those are good points to consider. Yeah, those numbers are blowing my mind. I'd love to see what they look like.
Cool. Well, maybe let me start with that, and if I can just show you again what China looks like, and just to contextualize, because I think it's always important to understand where things fit together whenever you're considering an investment, and particularly on the offshore side. It's worthwhile keeping in mind what your range of options are, and the considerations around that. So I've shown this slide in numerous webinars and presentations before. You might be familiar with it. This is just looking at the different types of indices, specifically that Satrix tracks from a global perspective, and how those sort of plug together and fit together, where they overlap, where they might not overlap and offer something different. So this is MSCI World, offers developed market exposure. And I just wanted to touch on your point as well, Carly, about diversifying globally. South Africa is an emerging market. So we sit outside of this developed market universe of companies. And from a South African perspective, it makes a lot of sense to obviously get that safer equity market exposure from markets that are more well established, just to provide that hedge against the risks that you often face within emerging markets. Those developed markets have become developed because they've gone through their years and decades of turmoil to establish the good governance and safe institutions which are well regulated, and all of those, that turmoil has now been settled, which is why they are stable and developed economies. We're talking Europe, the US, Japan, other parts of the world that which are advanced economies. They've been through their
problems.
Exactly, and those could have been 100, 200 years ago where they went through those growing pains. Emerging markets are still going through those growing pains, and that's obviously quite topical given what's happening in our country at the moment, and it happens in other emerging markets around the world as well. So I just wanted to sort of paint that landscape, and that's also why it's important when you're investing that you have a broad market exposure outside of just South Africa, because it provides that safety net, it provides opportunities to access growth in other parts of the world. So yeah, just coming back to developed markets, S&P 500, that's US exposure. We spoke recently about NASDAQ 100 and the very innovative companies that index in particular gives you exposure to, but all operating in the developed market space or listed in the developed market space, although many of the companies in that space obviously service and provide services to the globe. So whether you're living in emerging markets or in developed markets, these companies are typically services and products that you would buy.
Yeah, those are those big names.
Exactly. So then within emerging markets, this is where we find China. And these numbers here just refer to the number of companies within these various subsets. And I've drawn the size of these boxes to be largely to scale relative to the size of developed markets from a market cap perspective versus emerging markets. And you'll see emerging markets are about 13% of this entire investable opportunity set. So much smaller from a amount of capital that they represent versus developed markets.
Okay.
When you group those all together, we call that All Country World Index from an MSCI perspective, or ACWI as is commonly known. So MSCI China fits within the emerging markets sleeve, makes up about 38% of the emerging markets index. So within ACWI, it's less than 5%. And I guess that's where it gets really interesting about talking around the investment case for China, is that even though it only makes up less than 5% of the equity universe, its economy, I'm just going to jump to this slide here, its economy, which is shown on the left here, from a purchasing power parity perspective, is close to 20%. It's the second largest economy in the world, behind the US. So it's a massive economy. But from a capital markets perspective and an equity markets perspective, it's very, very underrepresented within global capital markets. And so that's the real opportunity set that exists, that, you know, as China continues to grow, it's going to continue to take up a bigger slice of the global economy. And it's a natural progression that is likely to occur on the equity markets, particularly as they open up more to foreign investors. So that's one of the reasons why China has been relatively underrepresented within the equity universe, is because the markets have historically been closed to foreigners. It's only over the last few years that those have started to open up and are now representing an increasing portion. And the expectation is that will continue to open up and represent a greater portion of the equity investable universe.
I'm getting this saying in my head, like, dynamite comes in small packages. Like, it feels to me like there's so much opportunity just packed into that China market, and it could, you know, explode at any minute. That's sort of the sense that I'm getting from these numbers. It's amazing how much GDP it takes up for being such a small percent of that.
Yes.
MSCI ACWI. ACWI is the word of the day. I've never used it before, so thanks.
Tisa, I'm not quite sure if you mentioned which city you stay in China.
She might need to pronounce some of these for us, I think.
Oh, I can help.
So.
I used to live in Weihai. Now I am in Suzhou. And Suzhou is really close to Shanghai, like less than an hour to get to Shanghai. Shanghai, Tianjin, Nanjing, Beijing, Guangzhou, Chengdu, Chongqing, Shenzhen, and Wuhan. Shenzhen is actually think of Shenzhen like the Silicon Valley of the United States. That's where all the big tech companies are, in Shenzhen. Yeah.
Okay.
Yeah.
Interesting.
So I'm showing you this slide because it just provides an indication of the scale of the Chinese economy and the number of people living in cities. So what it's showing is the size of these cities in terms of population. I mean, these numbers are the size of countries, which is what just in terms of population. But it also shows what the GDP of those cities are, and what these cities produce, and the amount of economic activity occurring in these cities is equivalent to the size of some countries around the world. So, that's what's listed over here on the right. But the interesting part is that China's GDP per capita is still relatively low. And that's one of the reasons that it's still classified as an emerging market, because, basically GDP per capita is so the GDP of the whole country, but then you divide it by the number of people that live in that country. So that's still relatively low, given it's such a large population. So as China continues to develop, and as the population becomes more affluent, their net wealth increases, it's likely that the economic size of these cities from a GDP perspective will become multiples the size of those countries that they currently equate to. So that really also speaks to the growth potential.
Am I understanding you correctly, Kingsley, in that the GDP is then seen as almost being spread too thin? Is that why it's seen as still an emerging market, or does it mean something different?
Yes, it just means, when you look at, because GDP is the number in aggregate of the country in total, but it doesn't look at how much GDP is effectively being produced by each person.
Oh, I
and
see, okay.
so as China continues to develop, and as that wealth filters down to more and more of the population, as that population moves more out of rural areas into more cities, and start moving into more of the formal economy, perhaps out of less of the moving away out of the agricultural economy, so their GDP will increase. The GDP of China overall will increase, and that will obviously get shared and lift the GDP per person within the country. And that, if these cities stayed at the same size, and the GDP per capita increased, these cities would be multiples the size of GDP relative to these other countries. So again, just talking about how large China is and what the economic opportunity is there.
Wow, so interesting. Now, I'm quite keen to see, okay, wait, you've got more exciting. I want to jump straight into what is actually in this ETF and hear a bit more about the companies. Because that's
I think in the interest of time, we need to do that, Carly. So
let's do it.
Let me jump to that. I want to show you this firstly, and I've shown similar slides like this in previous presentations. So what I'm doing is highlighting the largest 20 emerging market companies. So you'll see some names here that might be familiar to you. Tencent, for example.
Alibaba, for sure.
Yep, Samsung. We probably, many of us use Samsung devices, Samsung electronics. But you'll see the countries that are represented here amongst these largest 20. So China is well represented in that largest 20. There's South Africa as an emerging market. Naspers is our biggest stock in the Chinese, in the emerging market index and on our local exchange. Brazil, India also represented there. Taiwan and South Korea. Those are your real powerhouses across the emerging market universe. But let's zoom in on the China companies for a moment. So let's talk about Alibaba, for example. So this is a multinational tech company specializing in e-commerce, retail, internet, and technology services. And it owns and operates a diverse portfolio of companies around the world. We've probably heard of Jack Ma and his success in building this business. But again, I was touching on it earlier. They achieved a historic milestone of servicing 1 billion annual active customers globally at the end of March 2021. So that's their number of active customers that they service. So, I mean, it's just absolutely huge. And as I run through some of these other companies, Tisa, you're going to have to help me with the pronunciation here. How do you say this company? Meituan?
Meituan, yeah. Meituan is actually going to deliver my dinner.
Okay.
I order on Meituan almost every day because it's so cheap, it's so convenient, it's so quick. Almost everyone in China uses Meituan, but they don't say Meituan, they say Wai Mai. And even when they call you, they're like, Wai Mai Dao La. That's like your food has arrived, your order has arrived, or something like that.
Cool.
So I believe Meituan means beautiful group. That's actually what the meaning of it is. And as you've said, it provides retail services, including entertainment, dining, delivery, travel, and other services. So it's I guess it's in many senses the Take-A-Lot or the Uber Eats of China, if I'm not mistaken. Yeah.
Yes.
Yeah.
Are there any other companies there that you recognize?
And they serve about 560 million, they have, on average 560 million transacting customers on a monthly basis.
What company is that, Kingsley? We lost you for a second.
JD.com.
Oh,
You'll see
JD.com.
Yes, it actually says it's an ADR. So what that means is it's listed in developed markets as well. In fact, that company is listed on the NASDAQ. It's part of the NASDAQ 100 index, which we've spoken about in another webinar. And I found this company quite fascinating. It's also known as Jingdong. That's its other name. And it also provides technology, internet-based service delivery to customers. But this is a really fascinating company in terms of how it's utilized technology to provide these services. Utilizes high tech and artificial intelligence delivery through drones, automated robots to be able to essentially service that last mile of the customer leg to get products from warehouses to customers. So, Carly, if it's okay, can I give her a little bit of some video entertainment so you can just get a feel for what this company does?
Let's do it. Let's do it.
Okay, let's just.
So you're just making me want to visit China.
You have to come. You definitely have to come. You'll fall in love. At least you don't have to worry about language barriers. I'll be your translator.
I'll hold you to it.
Okay, let's kick this off.
Whoa, that is mind-blowing.
I know. It's, the reason I love that is it just talks about how technology can create access and break down barriers of being able to deliver services, making products and services more accessible, democratizing that process. And I mean, those are things which, at Satrix, we're very passionate about. So this really just really spoke to me when I saw this. And the particular video was obviously focused on an initiative in Indonesia by JD.com, but JD.com pioneered this within China to also reach hard to access places, within China, outside of the more developed cities. So just the way that technology can be used to really create innovative solutions. And when you read through what the different companies are doing within that Chinese universe, you see that they're all doing very innovative and creative things.
Wow, that is super inspiring. Please let that come to South Africa at some point. I would love my stuff to be delivered by drone. It'd be very interesting. Tisa, do you have any questions for Kingsley? I know you jotted some notes and I don't want you to miss the opportunity.
When I went onto the ETFs, .EasyEquities.co.za site, that's like my favorite site because it simplifies everything surrounding ETFs, comparing ETFs, learning about ETFs. And in preparing for this webinar, I went back and read about the MSCI China ETF, and I looked through the MMD, the minimum disclosure document, and I found some terms there that were a bit difficult to understand, because I read the objective of the ETF, which is usually the first piece, the first paragraph that we'll find. And I found, what are A shares, H shares, B shares, red chips, P chips? What does that mean? I found that in the objective when they were describing the ETF, and I didn't know what that meant.
You went deep, girl. I like it.
Sorry, Kingsley.
You're keeping me on my toes here, Tisa, but thankfully I've done my homework, so I'm gonna share some share a slide if I may again. Let me just do that quick.
Okay.
Sure, I haven't heard of those either, I must be honest.
Okay, is that coming through again, Carly?
Yes.
Yeah.
Okay, so this is the breakdown of those different shares that you were mentioning, Tisa. So let's start with the A shares. What are those? So these are companies that are listed on either the Shanghai or Shenzhen stock exchanges. They're trade in renminbi, which is the Chinese yuan currency, if I've pronounced that correctly.
Yeah.
And so these shares trade on mainland, in mainland China. They have been opened up for, to foreigners to access. Historically, they weren't. They were restricted for, to only Chinese nationals being able to purchase or trade them. So this is the segment of the market that is now opening up. And this is what MSCI have now added to their index to allow, for them to be represented within the emerging and acqui indices, for example. But they've only included 20% of the size of this A shares market. So there's another 80% of this A shares market which is not yet incorporated in the MSCI indices. Okay, so that's local shares, and this really represents the bulk of the Chinese capital markets. Then there's a very small slice called the B shares. These are also mainland shares, but have always been available for foreigners to invest in, but it's a very small segment of the overall market. The H shares, these are listed in Hong Kong dollars. And so these trade in Hong Kong, and these have also always been accessible to foreigners. And this is where a lot of those big tech names that we were discussing previously, a slide or two ago, that's where you typically find these companies, the H shares, such as Alibaba and Tencent, etc. The P chips are also listed in Hong Kong and trade in Hong Kong dollars. And these are non-state-owned Chinese companies. So they're also incorporated outside of China. So that's why they're known as P chips, but they're specifically not owned by the Chinese government in any way. The red chips are the same, also listed in Hong Kong, trade in Hong Kong dollars, but they're majority state-owned companies. So, we can relate to those types of companies in South Africa. We have a number of state-owned companies ourselves. They're listed on the stock exchange as well. So, for example, Telkom would be a good example where the state has a stake in the company, but it also trades on the stock exchange. So that's what the red chips would be from a Chinese perspective. And then lastly, there's quite a big slice of companies which are known as overseas, also referred to as N shares or ADRs or GDRs. So these companies typically trade in dollars or euros, and they would be basically all Chinese companies that are listed on foreign exchanges. So JD.com would be an example of that, and use a depository receipt structure. So that's just the breakdown. It basically talks to how these companies are set up to access capital markets and where they're listed. And historically, as I mentioned, the A shares were not accessible to foreign investors at all, but this is the segment of the market within China that is opening up increasingly.
Does that make sense, Tisa?
It does, and I would have never guessed. I was going to do the research, but I was like, nah, I'll learn at the webinar. Thank you so much, Kingsley.
My
Now,
pleasure.
Kinglsey, one thing we haven't really touched on, and I see we've got a question from one of our users that sort of, it's not really a question, it's more a statement, but I think we can loop into this. We haven't really looked at overall performance of the MSCI China, which I think we can do. But the comment from one of our listeners is, MSCI emerging markets looks like a better bet than the MSCI China because it's more broadly spread. So I don't know if that's something to think about. I mean, obviously it's about your own personal strategy as an investor and what your portfolio makeup looks like. But is there merit in rather going for more broader exposure, or is there merit to having a higher concentration specifically in China? I guess that's the question.
Yeah. So, I mean, Carly, I think your point around investors approaching the construction of their portfolios is always going to be, you know, a multifaceted discussion, and it's going to have to factor in a lot of different objectives and risk profiles and philosophies that you approach in that investment journey. But the way that I like to think about investing and allocating to China versus emerging markets versus developed markets is always to start with the broader exposure initially, because if you start with emerging markets, you get China within that. If you start with developed markets, you get a lot of those NASDAQ 100 companies within that, for example. So it's almost a bit like a funnel. You start wide, and then once you get comfortable with the concept of investing offshore, having that exposure to hard currency companies, and also the effect that the rand dollar exchange rate or rand versus any other currency impact, the impact that has on your investments, you can then start becoming a little bit more niched and focused on where you want exposure and what you want your portfolio to look like. But I thought this would be quite an interesting thing to show you, just in terms of how China differs from emerging markets. So what I'm showing you here is the sector exposure of the MSCI China Index, which our ETF tracks. And you can see it's very much dominated by consumer and communication stocks. Now, we know from having looked at that previous slide, I'll just flick back there actually, when we looked at those specific companies, I'm just going to go there. If you look at these Chinese companies, you'll see Alibaba, consumer discretionary, Meituan, consumer discretionary, Naspers, consumer discretionary. We know, even though that those companies are consumer stocks or communication stocks, they're very involved in technology and being able to operate their businesses. But just coming back to this, you'll see that China really reflects that growing consumer-driven economy, which it is now, very much like the US, is very much a consumer-driven economy. And you see this through the sector exposure. But where it gets interesting is to see how this differs from the kind of exposure you get from emerging markets more broadly. So that's what I'm showing you now in orange. And you can see much higher exposure to tech. And maybe we could say, well, we know that this consumer discretionary and communication is also tech. So maybe that's a bit misleading. But have a look at some other differences here. Look at the materials and the energy. We can think of those sectors as being resources, a sector we're very familiar with from a South African perspective. And you see that coming through in emerging markets more broadly, much more of a resource focus, whereas China is much more of a consumer-driven focus. So it would be using those resources from other parts of the emerging markets around the world in order to serve their consumer base, to manufacture things which we know China is very renowned for, in order to export those products to other parts of the world. And then, I mean, to make it even clearer, I've had a look at what emerging markets look like if you exclude China, and that just really puts it into focus. So much higher exposure to resource stocks outside of China. If you strip out China and just look at emerging markets excluding China, you see that higher exposure to resource stocks, much higher exposure to financial stocks, and less exposure to the consumer type stocks. But Carly, you also asked about performance, which I'm happy to chat to if you want.
Yeah, let's take a look. We don't have too many questions, so we've got a bit of time.
All right. So I'm going to recap a slide which I've shown numerous times before. We covered this in the NASDAQ webinar, which you can also access. We're looking at US dollar total returns on this chart. It's a log scale. So just to explain what that means, if you move from one grid line to the next, that represents 100% return if you go up. And if you drop from one grid line down to one below, that's a 50% reduction. And the reason we plot it as a log scale is if you don't, you'll start seeing your movements towards the end here being a lot more amplified. And then you don't really get a sense as to what the index is doing through time, because it's is a compounding effect which starts to distort those movements. So we spoke about NASDAQ in one of our other webinars quite extensively. I've just added a few other indices because it's always useful for context. You can see how NASDAQ's roared ahead versus developed markets, roared ahead of the rest of the US given its tech exposure. And then I've plotted emerging markets here as well. And you can see how well emerging markets have done over a long period of time, but really a tale of two halves, doing exceptionally well pre-global financial crisis. But subsequent to that, it's been a little bit more muted. You know, if you look at developed markets from this point, for example, they've gone up from 100 to in excess of 400, whereas emerging markets have gone from 400 to just below 800. So you can see much higher returns coming from developed markets. And that's really a function of easing the access to money, making money more accessible with quantitative easing, trying, you know, those economies trying to re-stimulate and protect themselves from the after effects of the global financial crisis to ensure that they have ongoing economic growth. So that's really favored the developed markets, even though their growth rates are much lower. We know there are much higher growth rates in emerging markets, China in particular, but from a capital markets perspective, developed markets have really been where the action has been because of the lowering of interest rates.
Okay,
so let's have a look at China now. This is what I've plotted in purple, and you'll see it by and large has corresponded quite closely to emerging markets. You see a very similar shape in terms of those returns through time, and particularly post global financial crisis. I guess that stands to reason. There's quite a lot of overlap between China, or China makes up close to 40% of EM, so you'd expect them to be somewhat similar. And we see that also being quite similar if we look at our own market, the all-share index, also in dollars, quite a similar shape to what we see playing out for emerging markets and China as well through time. So that's what China has done. It's pretty top performer, but if you have a look towards the end here over the last year or so, you can see the returns have actually declined a little bit. The purple line sort of peaked perhaps midway through 2020 and has declined from that point and has sort of gone a bit sideways, whereas if you look at something like the NASDAQ 100, it's continued to go up. The US has also continued to appreciate, as have developed markets. So this talks to another very important variable at play when we're looking at investments, and that's a function of what the currency is doing. So I just want to show you that this is specifically looking at the dollar versus the rand. You'll again notice here that when equity markets go through periods of distress like the dot-com crash and the global financial crisis, you'll see our rand weakens. So when this black line goes up, it means the dollar is strengthening and the rand is weakening. And then when confidence resumes, the rand tends to recover. And then again, if you're faced with another crisis, the rand weakens. And it's a proxy for that emerging market risk. When there's a crisis unfolding, investors tend to flock to safe haven assets, and the dollar is one of those safe haven assets. So that tends to mean that emerging market currencies suffer, bear the brunt of that. And you'll see that played out as well during COVID. In early 2020, the rand weakened dramatically as that crisis unfolded. We've seen it strengthen dramatically since then. as confidence has come back. And obviously, as we've seen more recently with some of the unrest we've experienced locally, the rand has again weakened in response to that. So when you look at these, when you look at this performance, and particularly when you invest in the Satrix China ETF, you're not going to be getting these dollar returns because you've also got the currency effect at play. So what you're actually going to be experiencing is multiplying this exchange rate by these dollar returns, which gives you what's happening on the right here. So you can see that it amplifies the returns because the rand over this long period has weakened. So that's an amplification of your dollar returns, which gives you these much higher returns that you're seeing on the right. But yes, you can see that China has taken a little bit of a, it struggled a little bit over the last year or year to date. And some of that would talk to the risks present within emerging markets. For example, we know that the Chinese government has been increasing regulation on some of these big tech names, making sure that they're protecting their clients' information. We're familiar with POPIA legislation that's just come into effect in South Africa. That is also playing out in China. And whenever there's new legislation or the goalposts get shifted, that always creates a little bit of uncertainty for investors. But I think one should always bear in mind that when you invest in risky markets, and emerging markets are more risky than developed markets, and when you invest in equity markets, that's very much a risky investment. It requires a long-term horizon. And I think from a long-term perspective, the China story is a very solid one, given the increasing share that China is going to represent of the global economy. It's a country that's growing faster than any other country around the world, and particularly much faster than the global powerhouses like the US and Europe. So it's going to continue to take an increasing share of that global economic activity. And as that plays out, China is going to become larger and larger and more of a significant force to be considered within our portfolios.
Started from the bottom, now we're here. That's China's mantra. We've got one more question before we wrap things up, which I think is quite an interesting one. If China ever gets declassified as an emerging market, would Satrix drop this position, I think, from the emerging markets ETF? Because we've actually just spoken about how it's really growing and it at some point could not be considered an emerging market. So yeah, interesting question.
Yes, so I mean, we would always have the China ETF as a standalone, but I think the question was, would China then fall out of the emerging markets universe? And yes, certainly if MSCI were to promote China to a developed market economy, then yes, it would fall out of the emerging markets and would move to the MSCI World classification. And again, that bodes very well if that were to ever happen, because the allocations, as you've seen, and when I showed you those blocks of how everything fits together, the allocation of capital to developed markets is much larger than it is to emerging markets. So that represents further upside potential and investor interest in China as an investment destination, if that were to ever happen. But I think that might still be a way off. I don't think there's any discussions about that at present, or that, I don't know if that's being actively considered at the moment. We must remember that China is still not fully open to foreign investors from an inclusion perspective. MSCI only include 20% of that A-shares market currently. So I think they would only look to incorporate China as a developed market once the market is fully open. And then they look at other things as well, such as what we were talking about earlier, the GDP per capita. What is the level of development and wealth of the, of the average person within the Chinese market relative to developed market peers? So only once it reaches a sort of an equivalent level would it then be more eligible for inclusion as a developed market country rather than an emerging market country.
So much to think about. I love this. I'm going to rewatch this whole webinar and just, even pick up even more little things every time. Thank you so much, everybody, for joining us. If you want to, like me, be a nerd and go back and rewatch all of this stuff, you can check out our YouTube channel. We post all our webinars there, so you can can go back and check it out then. Tisa, thank you so much for joining us. Enjoy your evening there in China, and looking forward to chatting with you again soon. And thanks to you as well, Kingsley. It's been awesome having you.
Thank you so
You're
much, Carly.
welcome. I'm about to order from Gate 1 and have dinner.
Awesome. You must enjoy it. Thanks, guys. Thanks for joining us.
So easy, so easy.